Most people spend years learning how to make money. Very few spend time learning how to protect it. And almost no one seriously thinks about what happens to their wealth if they're no longer around to manage it. Now add crypto into that equation, and the stakes become even higher. Because crypto changes one fundamental rule. Ownership is no longer tied to identity. It's tied to access. And that single shift creates both opportunity and risk. Because if something happens to you and your crypto isn't properly structured, it doesn't get passed down. It doesn't sit in limbo. It simply becomes inaccessible. And in most cases, that means it's gone forever. 1. The silent failure of digital wealth. There's a growing amount of crypto that is already lost. Not stolen, not spent, just inaccessible. Wallets with no keys, accounts with no recovery, assets with no clear ownership trail. This isn't theory, it's already happening. And as more families accumulate digital assets, this problem will only grow because people focus on buying crypto, but ignore what happens after. 2. Why traditional inheritance doesn't work here. In the traditional system, inheritance is structured. Banks have processes. Courts recognize ownership. Executors can step in. Assets can be located, verified, and transferred. But crypto doesn't follow those rules. There is no central authority to contact, no institution that can override access, no system that says, "This belongs to your family now." Crypto operates on a simple principle. If you have the keys, you have control. If you don't, you have nothing. That's it. And that's what makes inheritance planning critical. 3. What a crypto trust actually solves. A crypto trust is not just about holding assets in a legal container. It's about solving 3 core problems: control, access, protection. Control defines who ultimately owns the assets. Access ensures those assets can actually be reached. Protection reduces exposure to legal and financial risks. Without all 3, the system breaks. 4. Lawsuits and liability protection. One of the most overlooked risks is legal exposure. If crypto is held directly under your personal name, it can become part of legal claims, business disputes, debt recovery, civil liabilities. Now, a trust doesn't make assets invisible or untouchable, but it can create separation. A properly structured trust places a layer between you and the asset. That layer can limit direct ownership exposure, define specific use conditions, control how assets are accessed. This is not about hiding wealth, it's about structuring it intelligently. 5. Tax complexity in the digital age. Crypto taxation is still evolving globally. Different countries treat it differently. Some tax gains heavily, others treat it as property. Some have unclear or changing rules. Without planning, this creates confusion, and confusion leads to mistakes. For example, untracked transactions, incorrect reporting, unexpected tax liabilities, inefficient transfers. A trust introduces structure. It creates records. It defines ownership pathways. And while it doesn't eliminate taxes, it can reduce chaos. 6. The biggest risk: access failure. Here's the most important reality. You can have the perfect legal structure, but if no one can access the crypto, it doesn't matter. Because blockchain systems don't recognize legal documents. They recognize keys, private keys, seed phrases, wallet access. This creates a unique challenge because you need to balance security, accessibility, too much security, and no one can access it. Too much accessibility, and it becomes vulnerable. 7. Building secure access systems. This is where modern solutions come in. Multi-signature wallets are one approach. They require multiple approvals before a transaction is executed. This reduces single-point failure. Another method is distributed key storage. Different parts of access information are stored in separate locations. No single person has complete control. But together, access is possible. Clear written instructions are also critical. Not vague notes, not assumptions, but step-by-step clarity. Because under stress, complexity leads to mistakes. 8. Choosing the right people. A trust introduces roles: trustees, beneficiaries, executors. In the crypto world, these roles become more demanding because they require more than trust. They require competence. A trustee must understand how to access wallets, how to execute transactions, how to maintain security, how to follow legal instructions. Choosing someone without this understanding creates risk. But choosing someone purely technical without trust also creates risk. So the decision must balance both. 9. Education is part of inheritance. You cannot separate digital assets from knowledge. Passing down crypto without understanding is like handing someone a locked vault with no instructions. Eventually, something goes wrong. That's why education must be part of the system. Explaining how assets are stored, how they are accessed, what risks exist, what actions to avoid. Because one mistake can undo years of accumulation. 10. The privacy dilemma. Crypto offers privacy, but complete secrecy creates problems. If no one knows assets exist, they can't be claimed. If no one understands the system, they can't manage it. So there must be a balance. Enough privacy to protect, enough transparency to transfer. This balance is what separates smart planning from risky behavior. 11. Planning for real-world scenarios. Most people think in extremes: death, total loss. But real life includes many situations: temporary incapacity, medical emergencies, travel restrictions, lost devices. Your system must handle all of these, not just the final outcome. Because access delays can create financial problems, even if assets still exist. 12. Integration with traditional wealth. Crypto should not exist in isolation. It should be part of a broader system. A system that includes cash reserves, traditional investments, physical assets. Because diversification reduces risk, and integration creates stability. A crypto trust should align with overall estate planning, not operate separately. 13. Long-term thinking. The biggest mistake people make with crypto is treating it like a short-term opportunity. But inheritance is long-term by nature. It requires thinking beyond yourself, beyond current markets, beyond current trends, because what you build today may be used decades later, and that requires durability. 14. The cost of doing nothing. Many people delay this process. They assume they'll handle it later, when they have more assets, more time, more clarity, but delay is risk. Because unexpected events don't wait, and without a plan, even valuable assets can disappear. 15. Crypto perspective. A crypto trust is not just a legal structure, it's a system of thinking, a way to connect digital ownership with real-world continuity. It forces you to answer difficult questions. Who controls this? Who can access it? What happens if I'm not here? And those questions matter. Because wealth is not just about accumulation, it's about continuity. If you're building wealth in crypto, you're already operating in a new system. But if you don't plan for transfer, you're still thinking in the old one. And that mismatch creates risk. Because digital wealth without structure is temporary. But digital wealth with planning becomes inheritance. And that's the difference between owning assets and building something that lasts. And once you begin to understand this, you realize something most people overlook. Building wealth is only half the job. Transferring it correctly is the other half. And in the world of crypto, that second half is harder. Because there are no default systems, no automatic protections, no built-in safety nets. Everything depends on how well you plan in advance. Another important layer is documentation, not complicated legal language, but clear, structured information. What wallets exist, where assets are stored, what platforms are being used, and how access is organized. Because without clarity, even trusted people can make mistakes. And in crypto, mistakes are often irreversible. You also need to think about redundancy. What happens if one part of your system fails? A lost device, a forgotten password, a damaged storage method. If your entire setup depends on one point, it becomes fragile. But if it's distributed intelligently, it becomes resilient. And resilience is what protects wealth over time. There's also the issue of timing. When should access be granted? Immediately? Under specific conditions? Gradually over time? These decisions matter because too early can create risk, too late can create complications. So timing must be part of the design. Another factor people ignore is simplicity for others. What feels clear to you may feel overwhelming to someone else, especially if they are not familiar with crypto. So the system must be understandable, not just secure, because complexity increases the chance of failure.